Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending March 31st, 2023. And we ended the quarter today. I am Justin Klein, host of InvestTalk. Appreciate you all tuning in to this channel as well as to our podcast InvestTalk and subscribing. Now this week I'm going to title the video Mild Inflation Means Risk On for Assets, but What's the Next Shoe to Drop? And it's a long title, but that kind of sums up where we're at. And we had the inflation data come out today, and this is what it was. PCE was 5% year over year. Core PCE was only at 4.6% year over year. Continued moderation. Personal income up 0.3%. Initial jobless claims yesterday came in a bit higher. Let's go to the 1 year here. There we go. So a bit higher after the pullback in the fall. You really had this accelerating again. Pending home sales, that was earlier this week. That was down 21% year over year, but still, kind of improving. A lot of that's just base effects. Richmond Fed manufacturing, only -5, so not as bad as some of the other months we've seen throughout the last 12 months. But, really the data is this. We've talked about that the M2 money supply growth leads inflation by about 18 months. And so, what's 18 months ago? That's right here, September 2021. And inflation, or the M2 growth was still at about 13%. You didn't get until about, December, or I call it January, where that really started to decelerate again to the downside. So, to get these numbers back into the threes, call it, you're going to have to get in the back half of the year. But remember, the market looks forward. They see this data. They see what happened in the banking sector. And we'll get to some other data that basically pretends to, hey, they need to pause. And that's what the market is kind of pricing in here. If you bring up the September expectations, you have a 40% chance now that they're going to be cutting between now and December. And actually more if you include this 15%. So over a 50% chance that the market is pricing in a cut between now and December. Remember, we're at 475 to 500 basis points currently. And then a 35% chance of a pause. So only a 9.7% chance that they're going to increase one time between now and September. So that's what you're seeing here is the market is starting to price in a more dovish Fed, all right? Now let's dig into some charts, and this is the most important here, is the MOVE index. MOVE index is coming back in. Remember, if it's above 150, that becomes a problem. Now below 150, less of a problem. So that's certainly a positive for markets. The S&P really having a nice week, kind of breaking up above this resistance level. That's always a positive. And I could easily see this attacking the 4,300 level and this pivot point from last August. Would not surprise me to see that in the least. The NYSE, obviously a more broad index. That one still has a ways to go. Let's zoom out to the weekly here and just run a quick fib, which I'm sure we've done before, but let's layer that in there. And let's go back to the daily. And what you can see here is, actually, let me edit this real quick on the fly. Sometimes the Fibonacci doesn't want to put in the 7.5 retrace, and I don't know why. There we go. So we never got there. Could we attack that again? I think that's certainly possible. That is this breakdown area as well from last April when market broke down. Would not surprise me to see us go attack that. I expect a choppy year, or first half of the year, and a more bullish second half. And I still expect that. I still expect some choppiness here. So I do expect upside in the near term, but don't be surprised to see more of these large sell-offs over the coming months, right? Rally, sell-off, rally, sell-off. That's what a choppy period is really about. And this is probably the next shoe to drop. And that's why I title this that. And that is the commercial mortgage-backed security market. So this is CMBS to the IEF. So it's a ratio. And when this falls, it's showing that the spread on these commercial mortgage-backed securities are starting to widen out in a bigger way. Similar to the SHYG, to the SHY, right, where you're seeing that you saw that breakdown when you had the banking crisis a couple weeks ago. That's starting to reverse. So the credit markets in the corporate side are recovering, and that's good for equities. But when you're talking about commercial mortgage-backed securities, and you look at the chart itself, that looks fine, right? It's not doing great, but it's not terrible. But when you compare it to the Treasury market, that's when you see this starting to come under some pressure. And I've talked on the air about how this is a major problem: work from home, layoffs, higher interest rates, kind of triple whammy for the commercial mortgage market. And you're going to see a lot of defaults, and you already kind of are. So just a heads up there. And I do think that's the next shoe to drop, but I don't think that's going to happen next week or maybe next month, but maybe later this year. The VIX, that has come back down below 20. We know a lower VIX is certainly good for asset markets as a whole. All right. Let's see what else. Let's look at the dollar. The dollar, you would expect with the Fed pivot to get weaker, to maybe break the new lows. It hasn't done that. So that's what's interesting to me. Definitely keeping that on watch to see if that gets some further strengthening or further weakening. Right now, just kind of neutral, medium term. Gold prices, that has gone up to new highs for the year. Excuse me. Sorry about that. It's been a long day, long week. New highs for the year. You're definitely breaking out. GDX attempting to break out. Probably going to need some consolidation before we head to some new highs. The silver to gold ratio, that's one that I've been watching, and that's getting a lot of nice traction. That's always good to see for the precious metal market, to see gold get a bit of a rebound. You have the industrial sector, that also getting a nice rebound back above all the major moving averages. You have energy rebounding nicely, now back above the 200-day moving average. So that's looking nice there. Areas that aren't looking that healthy: healthcare, right? Still below the 50-day moving average, got in a bounce, but still not doing that great. Technology definitely recovered a lot nicer since the beginning of the year, and there's kind of a tell here, this higher low, and that growth to value trade has reversed to a degree, but it's still not, it's still not breaking out any long-term basis. This is a counter trend rally, which you got right in the April to October timeframe back in 2021, and you're getting a similar period now. So could this last a little longer on the back of the Fed pivot? I think that's certainly true, but you're still likely to see the industrial space outperform. Materials the hard assets, let's say that. Materials, energy, precious metals, industrials, the bread and butter type of businesses that have been around a lot longer than tech, they're starting to getting their strength back. There's been a lot of underinvestment within the space, and that means there's not a lot of spare capacity, which means margins improve and they make a lot of money in these times, and that's why they're doing so well. So that's what you're seeing on that front. The transportation index, I would like to see get more traction to the upside for the broader economy. So something I'll be watching to see if that can get some more upside. But overall, this is it was a good week. I wouldn't get over my heels that this is we're gonna break out to new highs on the S&P, back above 4,800 anytime soon. I don't think we're there yet. I think we're still in a choppy period where there's going to be fallout from higher rates. Let's go to the 10-year. The 10-year has pulled back, but it's not really breaking down in any big way. So I expect the 10-year to also be very range bound, but there are a lot of parts of the sector, the debt sensitive parts of the market, like real estate, are going to continue to struggle. And that's the difference you're going to see here. Is it's a very different economy than we're used to, because interest rates are now on this longer term uptrend. You're in this downtrend from 1982, 81, July of 81, all the way to the bottom, which was really the COVID crisis. And so the fact that this is now breaking out is should be a tell to you that this is the start of a longer term process. You're going to have pullbacks like you did this quarter where shits are going to drop. It's going to happen, right? Just like you had up moves in interest rates during this 35, 40, almost 40-year process of interest rates falling. Now you're getting the opposite effect. And that's likely to head higher, which is going to put pressure on growth stocks and really anything that's interest rate sensitive. So just be on the lookout for that and understand that that's more of a longer term trend, but there's always counter trend rallies. And this was kind of a quarter where you saw that counter trend, right? That pullback in interest rates coordinated with that increase in the tech stocks, right? So both, I think, will remain in their relative trends right now, but longer term, I expect that to reverse. All right, well, that's where we're at. I thank you for tuning in. I hope you all have a wonderful weekend. A reminder, the contents of this video are for educational purposes only, should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a great weekend.